Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. And at 11 o'clock, markets are still going strong, up 200 points on the Nifty, 650 points on the Sensex. But we've come off a tad bit from the day's high. At session highs, the Nifty was up nearly 400 points. Now we're up about 200 points. But still, it's a pretty good rebound after the massive sell-off that we had yesterday. Mid-caps are up 1.5%. A quick word on the picture across the Asian market. Hang Seng is leading the gains, rebounding after what was a fairly tough session for them yesterday. So Nikkei is up close to about 5.5% on expectations. It will get priority in trade talks with US. Nikkei is the one we're referring to. Nikkei is up close to about 5.5%. Hang Seng Shanghai up in the green, up nearly about 1%. Taiwan, though, continues to, come under stress. The Taiwanese markets, no rebound, no participating in the global rebound. That's still down close to about 4%. And names like TSMC, etc., are down nearly 4%. So after the historic fall that it had, the sentiment hasn't settled on all of Asia.
Thank you so much. And good morning, Reema, to you as well. Thanks so much for, number one, highlighting what's exactly happening as far as the Asian markets are concerned, given the fact that that is what has actually rubbed off in terms of a positive sentiment for the entire Indian markets. We opened in tandem with global markets, a bit of a bounce, cooled off the opening highs, but again, in the last 20 minutes or so, as you can see on the screen, the Nifty chart indicating a bit of a bump up. What's actually doing very well for the markets today? The financials pack. So Goldman Sachs today has upgraded quite a few stocks. So look at names like Axis Bank, SBI, PNB Housing, a double upgrade coming in there. So all of these stocks are the ones that are doing very well in the session. Remember, Axis as well as SBI have significant weightage as far as the bank Nifty is concerned, and they are the ones that have taken the markets higher. OMCs, it's been a very volatile trading session for all of the three OMCs, HPCL, BPCL, ISCL, opened higher, cooled off significantly, and now once again seeing buying activity. LPG price hike, that is something that the street would cheer as far as OMCs are concerned. However, the corresponding excise duty cut has taken a bit of a sheen off yesterday's announcement. And lastly, watch out for both BSE as well as MCX. You've seen significant volatility as far as markets are concerned. And on the back of that, the rising premium turnover is something that the street likes. So both MCX, number one, almost 5% higher today, and BSE is the other stock. Both of them have bounced back quite significantly post the recent pretty brutal sell-off.
Okay, and one more delivery. Today, it's seen a fall of close to about 6.5%. Yesterday, it was fairly resilient after it made the acquisition of the rival company Ecom Express. But today, selling pressure visible on delivery. But let's get back to the big story, and that's oil marketing companies. Lots of news flow over the last 24 hours. An excise duty hike of 2 rupees per litre on petrol and diesel. An LPG cylinder hike of 50 rupees. What does all this mean for oil marketing companies? Sudarshan is now joining in to explain it. Sudarshan.
So yesterday, Oil Minister made 3 announcements. First, special additional excise duty will be increased by rupees 2 per litre. Second, LPG price is going to be increased by rupees 50 per cylinder, and LPG compensation to be made to oil marketing companies. Now, these announcements at the first go will look positive, will sound positive, but if you dig deep, it's not that positive. Why? Now, the first coming on excise duty hike. So, government has increased by rupees 2 per litre. Now, where will this excise duty go and where will it come from? First, oil marketing companies will borne this excise duty hike. So, basically, ideally, whenever the excise duty is hiked, the prices, retail fuel prices go up. But in this case, Oil Ministry has announced that retail fuel price will remain the same as it is now. So, OMCs will borne the excise duty hike, and now whatever money from excise duty that comes will be paid for LPG dues for FY25. So in FY25, total LPG under recovery was rupees 41,338 crore. Now from excise duty hike, total, as per calculation, around 30,000 to 32,000 crore might come, so that money can be used. But here there is a catch. Now, normally LPG compensation amount goes into special fund, but due to excise duty hike, this fund will go into exchequer amount. So basically, Oil Minister will have to go back to Finance Ministry requesting for that money to come as LPG compensation. Now, second is LPG price hike of rupees 50 per litre. Now, that is going to, so currently on one cylinder, oil marketing companies incur loss of around rupees 220, 250 per cylinder. That's a loss. Now, after an increase of rupees 50 per cylinder, there is a likelihood that that price loss will come down to around rupees 200, and this will help these companies to reduce their LPG under recovery for FY26. So, excise duty hike will be used for LPG under recovery compensation for FY25, and LPG price increased will be used to compensate for ongoing losses on LPG. Now, this was the announcement. The last question that comes, that will retail fuel price increase because of excise duty hike? The answer is big no, there will be no change. And here also, Oil Ministry announced that if crude price remains in the current range, basically $60 to $65, or even it increases to $68 per barrel, there will be a headroom for oil marketing companies to reduce fuel price. So this will also be uncertain on the oil marketing companies going forward. Now, what do brokerages feel? HSBC says that it maintains buy call on all the oil marketing companies, but it has cut target multiples due to increased risk perception. CLSA says marketing margin will remain higher than any of recent quarterly averages for Q4, because most of the oil marketing companies were making marketing margin of around rupees 12 to 17 because of sharp down move in the crude. And it also said that oil minister's comments raises the chances of a cut in retail price. So overall, these announcements were minor positive, but if you go in details, it's not that great, it's not that huge positive. Also, retail fuel price cut will be a focus area going forward for the oil marketing companies.
Thank you so much, Sudarshan, for joining us and telling us exactly what has transpired last evening and the implications for the OMCs as far as the entire excise duty cut and LPG cylinder price hike is concerned. But remember, yesterday Piyush Goyal cleared the air over BYD's plans to enter India, the Indian auto market, that is. Let's listen in to that, and also Sudarshan then joins in to explain what this means for M&M.
Well, we need to be convinced that they will work by the rules of the game, and several unfair practices which are gradually coming to light as more and more companies come to us with what's happening, the kind of dumping that's happening in steel, for example. I mean, as these practices come to light, we have to be cautious in whom we allow to invest in the country. We have to be cautious about our strategic interests, our security interests. So it's a mix of many issues before we are able to take that decision.
Okay, sorry, no BYD, yes for Tesla. That's the word coming in from Piyush Goyal. So Darshan, what does all this mean for, say, a company like Mahindra & Mahindra, which is a dominant player in the EV marketplace in India?
So if you remember last month when there was a news report regarding that BYD is going to set up a manufacturing unit in Hyderabad, that day we had seen a sharp fall in M&M stock price. It had fallen almost 6%. Now this announcement of Commerce Minister Piyush Goyal that it's a complete no as of now for BYD, it would be taken positively, and the reason is because recently M&M had launched two electric-borne vehicles, and the price range was above rupees 19 lakh and it was up to rupees 30 lakh. So normally BYD vehicles also come in the same range or slightly higher. So it was being seen as that if BYD is allowed in the Indian market to manufacture, so normally see, as of now, whatever vehicles we import, built-in vehicles, India charges 100% tax. But if it would have been allowed to manufacture in India, the prices would have come down and it would have been a huge competition for M&M. But now this Piyush Goyal's comment should be taken positively, and it will be positive for M&M because now there won't be any major competition.
Thank you so much, Sudarshan, for joining us and explaining what exactly the non-entry of BYD means for M&M. Well, there's been a significant rebound as far as the markets are concerned. First up, look at the entire FMCG pack. Falling crude prices especially bodes quite well as far as the paint stocks are concerned. So look at names like Berger Paints, look at names like Asian Paints. Both of these stocks are near the day's highest point. Also look at some of the pharma companies. They've rebounded quite sharply. Look at names like Cipla, Dr. Reddy's, Sun Pharma. There's been a significant rebound coming in as far as some of these names are concerned. We highlighted, some of the larger banking names, but have a look at names like Bandhan Bank. That particular stock up almost 4% higher in today's trading session. But what we'll do is we'll slip into a short break. Up next, we'll discuss what's buzzing in the market on the other side. Welcome back to Trading Hour. Well, let's have a look at the mid-cap and small-cap end of the markets. The mid-cap index up 1.7% in the session. The small-cap index up close to 2%. So it's a significant rebound that we're seeing from the brutal sell-off that we saw yesterday. In fact, if you look at the advanced decline ratio, there's been a significant improvement over there as well. The advanced decline ratio, advances far outpacing declines, especially when we are looking at, look at it, over 2,100 stocks in the green, just around 400 stocks in the red. But we are now shifting focus to the commodity space. Manisha joins in, and today we're focusing on crude.
Thank you for that, Vivek. Well, yes, we've seen some possible technical recovery come in for the crude oil prices. Overnight, we've seen 1% of gains come in for the crude oil prices. This is after very sharp losses that we've seen in many recent sessions, down by nearly 15% in the previous week itself. So some technical opportunity buying is what we've seen in crude oil prices. Also, this is happening after US threatens additional 50% of retaliatory tariffs on China. So the market's clearly slightly jittery there. Apart from that, the street does believe that the break-even cost for the shale oil producers in US comes at around $60 a barrel. So every time you will see 60 break on the lower side, there's going to be some resistance at those lower levels there. So as of now, our markets feel that there is some support or a bottom being created around these recent levels. But then apart from that, if you look at the kind of interest that crude has, we've been looking at record volumes in the Brent prices there. If you look at Brent trading globally, 75% of international crude oil trade happens in Brent in the Intercontinental Exchange, and we're looking at volumes really surging on Friday, on Monday, yesterday as well. The markets also are looking at the kind of cues that we've seen in sense of economic data. Chinese numbers have not been so great. US has FOMC meeting minutes that are going to be released tomorrow, and then you have manufacturing and retail data as well coming in this week itself, and markets would take further cues from that. In the meanwhile, a report from Citi says that they are cutting their price forecast for this year for Brent, and $60 is what they're talking about in the next 3 months itself. We are currently trading at around 65 on your screens there. There also is a report from JP Morgan which says that they're looking at a surplus of crude oil availability in this year. They're anticipating a number of 1.3 million barrels per day. This is in line with various other banks and brokerages as well. They believe that 1 to 1.7 million barrels per day of a surplus is what this year could be seen in crude oil prices, and that perhaps would continue to weigh on there.
Thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in next as the Nifty surges close to about 300 points. We'll also get in his top trading bets. Welcome back. Let's talk about Titan Industries because that is rebounding smartly after hitting 52-week lows yesterday. The company came out with their pre-quarterly Q4 update, and it looks like we've seen fairly broad-based growth, Mangalam, across the categories that they operate in, whether it's jewelry, watches, eyewear, etc. And a decent retail expansion footprint also continues.
Well, the Titan's fourth quarter update was fairly steady, and a large part of that can be attributed to the big rise that we've seen in gold prices itself. So their overall revenue growth on a standalone basis is around 25%. And remember, over 3 quarters of their revenue comes in from jewelry business, which itself has grown at around 25%. And in jewelry itself, gold grew at 27% for jewelry, and gold coins grew at around 65% year on year. Remember, these are low margin products for the company. So let's see how that pans out in terms of the overall margins for the company. The other verticals of the company, be it eyewear, watches, grew between 19 to 22%. The emerging businesses of the company, which is fragrances and ethnic wear and fashion accessories, in that ethnic wear, Taneira actually saw sales decline of 4%, because of which emerging businesses grew just by about 7%. CaratLane, which in the past has been growing upwards of 30-40%, has now seen a growth slowdown to around 22% itself. What does the company attribute this growth slowdown to and the growth up move to? The growth up move is led by higher, gold sales and the gold prices itself, but there has been low buyer turnout or single-digit buyer turnout, and that's because of the weakness that we're seeing in consumer sentiment at lower levels, and that's visible even in their studded business, which has actually grown in just low double digits as against the 20% plus growth that we've seen in gold verticals. So to that extent, while we're seeing good growth in their overall revenue, margins are something that the street will most definitely keep an eye out on, along with the sluggishness that we're seeing in emerging markets or emerging businesses for the company itself. Brokerage house Macquarie has an outperform rating on the stock with a 4,000 rupee target price. They believe good growth in jewelry and eyewear along with watches is the key takeaway, but the key weakness is the low turnout that they've seen in terms of buyers, especially in the solitaire, high-end solitaire businesses, which will impact their studded ratio, and therefore margins are something they will definitely watch out for.
Thank you so much, Mangalam, for joining in and telling us about what exactly is driving Titan higher today. But Bharat Electronics is gaining in trade on the back of an order win. Upansna joins in to tell us more.
Well, the company continues to bag a slew of orders in this month as well. Now, company has received order worth 2,210 crores for electronic warfare suite for Mi-17 helicopters from Indian Air Force. Now, this order forms a part of 5,000 crore order pipeline that the company had indicated when negotiations concluded pending finalizations. Now, this is the second order received from Indian Air Force in this month by the company, and mind you, company had earlier received order worth 593 crore on 2nd of April. Now, on the back of this order win, Phillip Capital says that the company has kicked off FY26 on a strong note, securing orders over 2,800 crore in orders within just the first week of April. It believes that the valuations of the company, they stand attractive at 27 times FY27 EPS and maintains a buy rating on the stock with a target price of 390 per share. So on the back of this, BEL continues to remain in focus with the strong order win momentum.
Thank you very much for that. Let's now turn our attention to the realty sector. Lots of Q4 updates coming through, whether it's from Godrej Properties or Shobha Developers. Vinny is now here with a complete picture.
Hi, morning. So in terms of Godrej Properties as well as Shobha Developers, we have Q4 updates. So for Godrej Properties, good numbers coming in the business update. Quarterly bookings have crossed around the 10,000 crore mark. Pre-sales have seen a good growth, around a 55% CAGR growth over the last 3 years. Now, this quarter, strong bookings was led by strong demand in the key new projects which were launched during this time as well. So, good performance on the new projects. Overall, FY25 booking value grew by 31%, which is beating the guidance that the company itself has given. And the highest ever booking value that they've seen on an annual basis was reported by the company this time. Other than that, the NCR, MMR as well as the Bangalore region saw a good performance as well in FY25 for the company, and overall business development was at around 26,500 crores in FY25. Good performance coming in from Godrej Properties in terms of Q4 update. Now, Shobha Realty, overall when you're looking at it, it's a good Q4 update, but on FY25 basis, it's a miss coming in on the guidance fronts, and that is why a bit of that worry that comes in on the overall FY25 sales decline front. Sales value grew by 22% for Q4, and overall in terms of volume grew by around 16%. Bangalore, which comprises around 80% of the business, saw good growth, while on the other side, we've seen Kerala business that saw a sharp fall in terms of the volumes as well, a decline of around 52% on a year-on-year basis. Overall sales volume for FY25 declined by 23%, missing the guidance that the company had spoken about, and that is why something that we're watching out for, though as of now, Shobha is still managing to hold on to gains of almost 2%.
Thank you so much, Vinny, for joining in and telling us about the realty space. But stay on, because we're also looking at the pharma space. And today, Goldman Sachs has come out with a very interesting report on the CDMO space with a bullish stance on two pharma stocks, both Suven Pharma as well as Piramal Pharma. Tell us and give us more details on that.
Absolutely. So, Subin as well as Piramal Pharma, they've initiated coverage on this one, Goldman Sachs, both these companies. Firstly, Subin Pharma, buy rating target price of 1,350 rupees per share. Goldman Sachs is highlighting that they expect a strong rebound, structural growth starting from FY26 and onwards. They expect continued traction in the top 3 to 5 drugs for the company. Potential approvals for newer drugs will come in, so which will lead to better growth for the company going forward. And successful integration of these recent acquisitions by the company, Cohance as well as NJ Bio, is something that will help the growth and enhance the growth for the company going forward. They expect the combined entities EBITDA to be compounded around 20% of CAGR in the medium term as well. So good growth expected going forward. Now on Piramal Pharma also, positive on this one as well. Buy rating, target price of around 275 rupees. They believe that Piramal Pharma is well placed to deliver a very good growth in terms of profit that they're expecting. PBT margins for the company, they expected to jump from just around 3% in FY24 to more than 16% in FY25. And what will 28, I beg your pardon. What will lead to this growth? The turnaround in the CDMO business, good growth in the CDMO business from FY26 and onwards. The company has been working on smaller molecule sites as well. So that is something that will support the growth. In the CHG business, they're expecting a capacity ramp up, which will lead to better growth in FY26 and onwards from here on. And as well as the consumer healthcare side of the business, they're expecting a turnaround there as well and good growth on that front. So overall growth for Piramal Pharma on the back of 3 segments doing well for the company.
Thank you very much for that. Goldman, in fact, has also written on the banking pack where they've upgraded a PNB Housing, Axis Bank, State Bank of India. But not just that, we also have a CLSA note on Bajaj Finance. Abhishek is now joining in. He's compiled all the notes that we've got on the banking sector. And he joins us to give us the details. Abhishek.
Well, Rima, to begin with, Goldman Sachs has written on financial services sector. Now, they have written on PNB Housing, upgraded the stock to buy new target prices about 1,184 per share. They say that the company's, visibility on profitability is improving, and along with the fact that loan growth is expected to remain strong. Axis Bank, they have upgraded to buy target price of 1,228 per share. They say that the valuation mean reversion is seen over here as profitability and growth are nearing bottom in H1 FY26. So the company or the bank is one of the big beneficiaries with respect to liquidity infusion into the system, which should support its loan growth trajectory going ahead. They have also upgraded SBI to buy from neutral. The new target price is about 823 per share. They say that the risk reward looks very balanced right now, and the stock has actually derated from 1.1x 12-month forward that it was some time ago to right now about 0.9x 12-month forward price to book value. So this valuation reversion that has been seen seems to be fair for a 90 basis point ROA franchise that SBI has. CLSA has written on Bajaj Finance. They have an outperformance rating with a target price of 11,000 per share. They say that with asset quality headwinds is receding for the lender, they expect Bajaj Finance to regain its class from FY26. So investors' focus should shift away from net interest margin or asset quality towards the loan growth trajectory for the lender. So even if ROA declines by 50 basis points, say from 4% to 3.5% over the next 5 years, and AUM grows at 25%, the PAT CAGR will still be a healthy 22 to 23%. So as per them, no other large stock in their coverage and probably overall in India offers such a healthy PAT growth over the next 3 to 5 years. Back to you.
Thank you so much, Abhishek, for joining us and giving us a roundup of what brokerages had to say as far as the BFSI space is concerned. Well, if you could pull up the intraday chart of delivery, you'll see that that stock is now seen significant selling pressure at the day's lowest point, almost 8% low as far as delivery is concerned. There you see, yesterday was a significant outperformer in the weak market, but today has given up all of those gains and, in fact, is now below where it was yesterday. But as promised, Mitesh Thakkar now joins in for a quick technical check on the market. Thank you so much for joining us, Mitesh. It's a very volatile last couple of days as far as the Nifty levels themselves are concerned. Where do you see markets headed from here on, and immediate resistance and support levels?
Yeah. So one, I think it will be choppy. You're right. I think this is a market which had a big gap down and then some short covering today. But my understanding is that till we actually managed to cross 22,600, 800 zone, which is where the gap happened. I think we'll see supply at higher levels, and we still haven't done any kind of base building, which means that on the lower side also, the earlier lows could be revisited. With that, the overall index was slightly on the negative bias, so it's a sell on rally kind of thing. In fact, instead of selling in futures because of the volatility, what we've advised people is to get into some kind of bear spreads or put spreads, and that could possibly make things easier from a trading point of view. On the stock side, I have one sell and one buy. A sell on Tata Steel with a stop at 133.5 and targets of 120. While Pidilite is on the buying side, keep a stop just below levels of 28.75. Look for 29.50 as the target area.
Got that. Thank you very much, Mitesh, for joining in. While IT is rebounding, one stock deserves mention, and that is Cyient. Cyient is up nearly 3%. Today, the company is holding a press conference at a hotel in Mumbai where they will talk about their new semiconductor subsidiary. Remember, earlier this month, or just about 2-3 weeks back, the company carved out its semiconductor business from the existing Cyient business and created a dedicated, wholly owned subsidiary because they believe this semiconductor business has a lot of potential and it requires its own focus and dedication. So the company will be holding a press conference today in Mumbai to talk about the potential. The revenues of the semiconductor business is about 225 crore as of 9 months of FY25. But what are the projections? What's the outlook looking like? The amount of investment that the company will be making in it. So Cyient should be a stock you should watch very closely. Get into a break. On the other side, market fundamentals lined up with Rohit Saxena from Sundaram Mutual Fund. Stay tuned.
Welcome back to Trading Hour. Well, Rohit Saxena from Sundaram Mutual Fund now joins in to discuss market fundamentals as well as its top sectoral picks. Thank you so much, Rohit, for joining us. First up, analyze for us, how exactly you've read all of the developments over the last 48 hours, the impact of the tariffs, and what is it that you like or dislike at the current juncture?
Thanks. See, short term, this tariffs and the narrative of the tariffs will keep the markets volatile. And it's very difficult to say how the entire tariff situation plays out because it's all dependent on what one individual wants to do. So I guess for the next 2-3 months, we'll have to wait it out and see how the tariff and its impact plays out in the short term. However, if we look beyond the tariffs, the domestic macroeconomic environment is improving. The sharp correction in the crude prices is going to help the domestic economy. Even it's going to help the government revenues. Like yesterday we saw government increased excise duties, which would shore up the government revenues, whatever shortfall they may have from income taxes. RBI, on the other hand, is ensuring there is sufficient liquidity in the system. From liquidity deficit environment, we have moved to liquidity surplus. That will ensure that the rate cuts which RBI does gets passed on. So we are looking at an environment, monetary environment, which is more conducive. And with crude price correction, you will have margin tailwinds. In such an environment, I guess once the tariff headwinds, we are clear over that, markets should rebound in that kind of environment.
The problem is no one knows how this tariff, certainty, how prolonged it's going to be. In the meanwhile, markets are going up, down, anywhere, and narratives are changing by the day. But Rohit, be that as it may, because it's outside our control. Are you putting money to work at current levels in the Indian markets?
See, as a house, we are always fully invested. We don't take cash calls. So we remain fully invested. And the way we are trying to navigate this is by focusing more on domestic part of the economy rather than looking at the export-oriented names. So that's how we are navigating this short-term tariff-related volatility.
Understood. Rohit, we are now heading into Q4 earnings season. In fact, a couple of numbers will start trickling in today, tomorrow. IT starts off. So going into Q4, what are your expectations? Where do you think we will end FY25 at? And any initial estimates that you have for FY26?
See, Q4, our expectations are in line with consensus expectations, mostly flattish kind of an earnings growth is what we are looking at for Q4. As I told that the improvement which we have seen recently, both from the crude and from the RBI side, will take time to flow through to the economy. So somewhere towards the later half of F26, I believe we'll start seeing improvement. So overall F26 should show a good double-digit kind of a earnings growth, would be my early guess right now.
What are the sectors that you like and what is it premised on?
See, as I told you, we are right now more focusing on domestic sectors. And one sector which I like the most right now is the banking and NBFC space. That's one sector where valuations have been very reasonable, and with RBI providing support not only from surplus liquidity, but from on the regulatory side, they are more supportive of growth now. So in such an environment, we believe the banking and NBFC space should do well. In the environment where RBI is cutting rates, your NBFCs tend to outperform as their interest margins expand. So that's where we are playing at. One concern this sector had about was retail asset quality, but that also we believe was too much was made out of it. It's well under control. So this remains the best sector according to me. Another sector which we look at is the consumer discretionary sector, the specific pockets of consumer discretionary sector like luggage, durables, restaurant, hotels. These are the pockets where we are looking to play.
Understood that. Rohit, you said, you have a very positive stance when it comes to the BFSI space. You also enumerated the reasons why you like that space. Now, within the BFSI pack, where does your preference lie? Is it the large banks, the PSU banks, private banks, or is it the NBFCs, or would you look at some of the MFIs that have been beaten down quite a bit?
See, right now, what I like most is the NBFCs and the MFI space. NBFCs, as I told, is a play on the interest rate cycle. As rate cuts flow through, their net interest margin should expand, and that should lead to a better earnings on the NBFC space. MFI space is very interesting. The valuations have corrected sharply because of the asset quality stretch which they endured for the last year. But the recent updates are quite encouraging. In most of the states, the asset quality has started improving. And in such an environment, I see a very good risk reward even in the MFI space.
Understood that. So BFSI, we have your views. Now, two sectors, that have been impacted the most, especially from the tariff tantrums. First is the IT pack, worries of recession, that is something that has led to significant selling. So IT, given the fact that FY26 Q4 expected to be quite muted, would you turn positive from here on? And what is your view on the pharma space? Do you like any names there? Would you be positive on that front?
Right now, I'm maintaining more of a neutralist stance, as the recession fears are more or less getting priced in. But now the growth, I don't see short-term growth surprises coming from that sector. So that's why I maintain more of a neutralist stance on the IT side. On the pharma side, it's a little more cloudy according to me. A big part of pharma earnings over the last couple of years came from one particular drug, Revlimid, and that's going to expire next year. So we need to see how that plays out is one part. And secondly, the entire tariff narrative, how it flows for the pharma, we don't know right now. So pharma, right now, I'm avoiding till the time the situation gets clearer.
Understood that. So IT, a neutral stance, pharma at this point of time is an avoid for you. Well, let's talk about, some of the domestic facing industries as well. Auto is one particular space, there's been significant volatility, worries about, impending entry of larger players from the US market, BYD entering, or maybe not entering, as is the clarification that has come today. So do you like autos at current levels? And within autos, where does your preference lie? Is it the passenger vehicles, the CVs, or the two-wheelers?
Yeah, I am positive on autos, and within autos, what I like most is the auto ancillary pack. It's the specific pockets of auto ancillary, because auto ancillary becomes quite wide. There are specific pockets of auto ancillary which are doing very well. They are gaining share, market share, and wallet share from the clients, and they are expanding well. So that's one pack we like. And within the four-wheelers, two-wheelers, I believe right now I believe four-wheelers gives us a better risk reward. One from the income tax cut this year, we are expecting some sort of a demand improvement, and some of it should flow in the auto pack, and more of it going into the next year when the pay commission revision comes in. That's when we believe the four-wheeler pack should start doing much better.
Okay, got that. Just wanted to get your thoughts in on the EMS companies, because there was this Apple news that how they're planning to send more phones to the US from India to offset the high cost of China tariffs. If this happens and it gets more broad-based, do you think it could be a big boost for EMS companies? The only issue is that while the opportunity is there, valuations have also been always, on the higher side for the last few years.
Yeah, see, that's again coming back to the tariffs or differential tariffs between India and China. Right now, it's very difficult to take a call on how it finally ends up. I don't think any company right now will be making changes to the supply chain based on the initial numbers which has come out. All the companies will be waiting for how it finally plays out, what's the final stable numbers, and based on that, they will be taking a call on how to reorient the supply chains. If the current numbers stay, then there may be some marginal benefit to Indian EMS companies. But as you rightly said, valuations are more or less pricing much of it. So right now, I am not that positive on the EMS names.
To that, thank you so much, Rohit, for joining us and giving us a view across a whole breadth of sectors, especially in this volatile time. But we'll move on. We'll take a quick break. We'll get you more on the markets on the other side.
Welcome back. Speculation on some sort of tariff pause circulated on social media caused stocks to whipsaw before the White House called it fake news. Prashant joins in more with the kind of a roller coaster session that Wall Street had, with more on this particular development. Prashant.
What does it take to move trillions in global markets, right? As last night we saw, all it needs is just one headline, and that too unverified, and as markets found out later, a fake one. Now, this is a story of how sentiment whipped in minutes based on pure speculation and nothing else. Let me tell you how this played out. Even as equity indices were starting to recover from the lows, rumors broke out on Wall Street that Trump may announce a 90-day tariff pause for all countries except China. The headline was picked up and flashed across news networks, and Wall Street went vertical. The S&P 500 added over $3 trillion in market capitalization from the intraday lows. I mean, in terms of percentage gains, the Dow was up 7%. I've taken lows to the high. Remember, some part of it, of course, already happened. And market, as I said, was already recovering when these headlines hit. S&P went up 8.5%. The Nasdaq rallied 10%, all in a matter of minutes. Well, but, in a matter of minutes again, but minutes later, came the first crack. Reports said that the White House was unaware of any such move. The White House officially denied the story to CNBC, calling it fake news. And almost immediately, the market went south, giving up all the gains it had accumulated a few minutes prior. In all, trillions of dollars, by some estimates, $5 to $6 trillion swung on the back of this headline, this fake headline, in less than 30 minutes, driven purely by hope, greed, herd behavior, and just general sort of anxiety. What are the lessons here? And I think the lessons are very true for our markets as well on a daily basis, but I think in markets like this, this is a market where there is extreme emotion. Markets are in a fragile state. Number one, you can't take headlines at face value. Please investigate sources first. I think that is paramount. It has to come from credible news sources, not an unverified Twitter account without any backing. Also, it kind of helps to say a bit cynical, especially in markets like this, unless proven otherwise, even if a short-term bounce cannot be ruled out. I mean, I think it just generally helps. Bring me proof. You have to have proof before you decide to act because there is real money at stake. And of course, as always, remember, short squeezes in bear markets, or I'd call it this bearish markets, can be vicious. I mean, they can be absolute rippers like what we saw yesterday. To wrap it up, I was wondering, right, and I think many are as well, markets were down sharply 4, they went up 4, so 8%, but they did not go down 4. We ended flat. Why is that? Why is that? And the reason perhaps is a little tongue-in-cheek, but, maybe the thinking, at least among some market participants, is this: imagine if a fake headline can do this to markets, what could a hypothetical real headline of some sort of relief do? So maybe better to be a little light. The simpler explanation, of course, I think is also in the mix, that markets are much cleaner. We've had 2-day historic falls, and people just want to stay a little light. So I think that is what we are looking at this point in time.
Thank you so much, Prashant, for joining and giving us a sense of what exactly transpired in a very volatile trading session as far as the US markets were concerned yesterday. But despite the sharp criticism against tariffs, President Donald Trump has shown no signs of reversing course. However, when asked whether tariffs are permanent or have space for negotiations, this is what he had to say.
They can both be true. There can be permanent tariffs, and there can also be negotiations, because there are things that we need beyond tariffs. We need open borders. There are a lot of things like opening up countries that were totally closed. China is essentially a closed country. In fact, it is a closed country. And what they do is they charge tariffs so that if you sell cars or if you sell anything, nobody's going to buy it because the price is out of control. But that's true with a lot of other countries also. So we're going to get fair deals and good deals with every country. And if we don't, we're going to have nothing to do with them. They're not going to be allowed to participate in the United States.
China, for now, appears to be fighting back. So there is no one who is backing down, at least between US and China. But several countries have reacted to the executive orders imposed by Donald Trump. We have Dia joining in our special segment, Trump Watch.
In response to the steep tariffs imposed on car imports by US President Donald Trump, Canada has launched a complaint with the World Trade Organization, the global trade body, said Monday. In the request, the Canadian government charged that the tariffs were inconsistent with US state obligations under international trade laws. Meanwhile, Israeli Prime Minister Benjamin Netanyahu met Donald Trump at the White House on Monday. The two are also set to discuss Gaza. Japan's Prime Minister Shigeru Ishiba said on Monday he had held a call with US President Donald Trump in which they agreed to more talks on the latest US tariffs. As the global trade landscape continues to evolve, India's Commerce Minister Piyush Goyal has weighed in on the ongoing tariff debate. Speaking on Monday, Goyal addressed the claims surrounding India's tariffs on US imports, responding directly to the Tariff King label given by President Donald Trump. Let's listen to what he said.
Our tariffs are a protection against these unfair trade practices, trying to remain abreast with new ways of beating the system. And a lot of our tariffs are to do with such protection against such economies. If you look at the United States, for example, while our overall tariff may be 17%, but a lot of it is products which we don't import it at all. Our applied tariff to the United States is probably 7 or 8%. It's not humongous. So really, it's a question of understanding India's tariff story.
That's all for today. Now back to you.
Thank you so much, Dia, for joining in and giving us a roundup of what exactly has been the response to the likely tariffs. Now, to discuss the impact of tariffs and also the way forward for markets globally, we spoke to a whole host of experts. Let's listen in to a few excerpts.
11% of the U.S. economy is imports. 40% of those imports aren't finished goods, they're parts. That gets confusing, but I think you would know what I mean when I say that has a big impact on the supply chain, because it gets very, very confusing. And if this is sustained or permanent, then it would require pretty massive change in terms of the supply chain. So I think the impact is huge. 11% of our economy is like 3.3 trillion. That's the imports. It's profound, and it's self-imposed.
The main thing is that this has dramatically raised the risk of a Smoot-Hawley type outcome. So Smoot-Hawley was 1930. Other countries retaliated, global trade collapsed, and the Great Depression was on. So I think that's really what has people worried about this. It doesn't have to work out that way, but this unilateral move, abrupt, is setting up a situation where you could get a dramatic downturn in the economy. So Wall Street is marking up its recession probabilities, and I think that's appropriate. And I think this is probably executive overreach compared to what Congress. You can do things like this if you want, but you probably have to have Congress weigh in on that.
We went into this with the U.S. being the most overhyped, overowned, and overvalued market in history relative to the rest of the world. That never before had so much capital flown to the U.S. 80% of all flows into the stock market globally went into just the U.S. market this decade. So there's a lot of unwind of that which has to happen, and a lot of that capital came in unhedged, expecting the dollar to appreciate. So that's why, that was something that we discussed was the mother of all bubbles, and that bubble is now being pricked. But this credibility damage is going to last. And I suspect that over the next few years, the U.S. stock market and U.S. assets are going to underperform no matter how this tariff drama is resolved. Obviously, global growth is going to take a hit, but I think that at the end of what's going on here, and something we've spoken about as well, is that the rest of the world is laser focused now on trading without America. So what's happening there is that they're sort of expediting their trade deals of trading with each other, as I've sort of written in the past as well, that if you look at the 10 fastest growing trade routes in the world, only 2 now involve America, 5 involves China and other countries. So the world is moving on, but obviously in the short term, everybody gets hit. But this is a very different kind of market reaction and even downturn that, as you know, that this time, even after the carnage in the international markets over the last couple of days, the US market has really underperformed, and the dollar, in fact, has weakened through this all.
And there are some estimates that the S&P 500 is still, after the correction, is still higher than the long-term averages. So even after the correction that we've seen, because of the whole of last year on the back of this US exceptionalism, we saw such a re-rating in the US indices. Get into a break. On the other side, we'll get you more in the market. Stay tuned.
Welcome back to Trading Hour. Well, tomorrow is a very important day. Remember, the RBI will announce its monetary policy decision tomorrow morning. Ritu joins in with the key expectations.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC-TV18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC-TV18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is, what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs. But for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
Thank you, Ritu, for that. Just a quick word in the markets as we wrap up on the show. Benchmark indices still up 1%, so 22,400 on the Nifty. So that rebound, it's been a largely steady session. Yes, we've come off a tad bit from the highs, but again, holding on strong. On the mid-cap end of trade, you've got some big winners. So one of them is 5-Star Business Finance. That's up nearly 9%. Vijaya Diagnostics, 8% on very, very large volumes. Capital market plays. We spoke about BSC, MCX. BSC appears to be gaining market share. For MCX, the options premium turnover numbers appear to be strong. But Angel One is also another mover there. Look at JM Financial. That's rallied close to about 4%. So if you have to pick a pack, a theme which is doing very well today, it's the capital market plays in a very broad-based way. Well, that brings us to a wrap on Trading Hour from the entire team. Thank you for watching. Don't go anywhere. Halftime Report is up next.